Today, we want to talk about the debate that is raging across the internet on whether QE is back with the Fed. And these debates are brought up because of this. At yesterday's 30-year auction, for $57.7 billion, the Federal Reserve, through their SOMA account, bought $8.8 billion of yesterday's offering. So if you look to the top here, you can see that the Fed bought $8.8 billion in the 30-year, on top of the $34.8 they bought in the 3-year and the 10-year. So the 3-year was $20 billion, and the 10-year was 14 point some billion. So that's a total of $43.6 billion over the last 4 days. We issued about $250 billion, so that's about 17% of the issue that the federal government bought. And this is what people are arguing about, whether this is QE or not. Because what they're doing is they're taking the interest that the Federal Reserve is earning from our $6.7 trillion balance, Fed balance sheet. They're taking that interest and they're buying these securities. Now, this may seem like semantics to people, and to me it does, but it's up to you. The question, though, is why are they doing it? Some people are saying that the balance sheet is running off too fast, which is QT. So remember, in QT, you can either sell the securities on the balance sheet, or you can just let them run off, come due, mature, okay? And they have cut QT from $25 billion down to $5 billion a month on $6.7 trillion. So in other words, it's going to take 400 years to have it run off. But if it's running off too fast, they may want to continue to maintain the balance sheet at a certain level. This is what the argument is. But in 1 week, we bought $43 billion, and we're allowing $5 billion to run off per quarter. And on the CMBS, you have to remember something. Our balance sheet is not monolithic. It had every maturity in there, but it also has CMBS in there. And the CMBS we treat differently. We just, as people refinance their homes, it runs off because that old bond goes away and they go into a new mortgage. Because the interest rates are up right now, there's not a lot of refinancing, so that's not the reason. So again, the Fed is buying the issues. Why they're buying them, I think, is what everyone's really arguing about. So we're watching the yields on our bonds. There's two, let's say, drivers, and you have to determine what you think is driving the market. There's inflation, and then there's are people not buying our bonds anymore. So on inflation, I just want to say this. Anybody who follows me on this channel knows that we are after the first phase of our inflation. We think there's going to be 3, and we're heading into the second one. So I believe in an inflationary environment, but we're watching the news to see if that's actually true. But what I think is actually happening with our bond complex is that we're getting less and less and less people using the dollar and using our bonds for their trading and their hedging. Now listen, I'm going to go through some data points here. It's just data points. We're following along to see if data points are supporting the narrative one way or the other. So we're not determining the narrative, we're following the data points. So some of the richest families are cutting their exposure to the U.S. assets, which would mean the dollar in the end. Now, I had someone work for me one time. He was from a fabulously wealthy Sephardic Jewish global family. And when Switzerland gave up the names and everything, they decided to move to Singapore, okay? And so I forget, a couple of months went by and I said, so does your family move over to Singapore? And he looks at me like, what are you, crazy? He said, Dan, it's going to take 10 years. All the corporate documents, all the trusts and all this stuff of a wealthy family, it takes 10 years to move. So remember that. Remember what we said? It's going to take a minimum of 5 years for people to readjust their portfolios. That's what we're seeing. We're going to see a constant drip of people moving away from the dollar. And here they're saying that the banks and brokers are seeing a rising demand for currency derivatives that bypass the dollar. So if you're going to do a derivative in, let's say, the old world prior to Liberation Day, it was always in the dollar. Now, that is not the case. People are looking on how to get out, and they're using the yuan, the Hong Kong dollar, and the euro. Now, we spoke the last time about the Hong Kong dollar, and we pointed out that you have in that area, Southeast Asia, Hong Kong, Singapore, Malaysia, Vietnam, all those countries added up, they own a total of $2.5 trillion worth of our treasuries. Now, here's the problem. If they're forced into defending their economy and their currency because of the tariffs that we are imposing upon them, their number one solution to the problem is selling their treasuries. And this is what they're talking about. If they unwind this, it's going to be an avalanche. And here in Bloomberg, they're talking about the same thing, that banks and brokers are seeing a demand for currency derivatives that bypass the dollar. So what kind of effect can that have upon us? And let's put it this way, does it even matter? So this year we have 9.2 trillion in debt maturing, 6 trillion over the next 6 months. So we just started 500 some billion that we've done. And we have 21.29% of our total debt, or 6.16 trillion, is in T-bills. T-bills, 30, 60, 90 days. That's all it is. The important thing here is the first one, increased interest rate costs, right? So the Congressional Budget Office projected interest rate costs will reach $952 billion in 2025, up from $476 billion in 2024. All right? That's because those T-bills are coming due, and they're coming due when we have to pay, the interest rates are up, not down. So the Fed, they're not stupid. What are they going to do? They're going to manage their duration. They're going to do a mix of short and long-term issuance to minimize how much interest rate that we actually pay. But here's the problem. Our total budget, federal budget deficit, is 1.1 trillion in the first 7 months of 2025. This is 196 billion more than the deficit last year at the exact same time. So not only do we have all these rolling over 9.2 trillion, we're also adding in more because of our annual budget deficit is going up. And we've just seen this when we've gone through this quarter, okay? We needed to borrow $514 billion, which actually was an increase from the previous forecast of 320%. So we were basically said we're going to raise 180 billion. We had to raise 514 billion. So we have to roll 9.2 trillion. We have the tax cut bill coming up. I think it will come up in September. That'll be another 5 trillion over the next 2 years, or 2.5 trillion a year. Our own deficit is expanding, annual deficit, so we have to raise more there. And more importantly, on top of that, we're paying a higher interest rate than we did last year on the debt that's rolling over. And you're seeing that it doubled the interest that we had to pay, okay? So that's an issue. So there's different things that the Fed does, okay? So we always say that the Fed will put in facilities, which are basically liquidity facilities to give the market liquidity if they need it. And one of the things they put in place in 2022, which is now we're going to watch, is FIMA, F-I-M-A. And here it is, the Foreign and International Monetary Authority's repo facility. So think about what a repo is. In America, if a bank needs funding overnight, they do a repo overnight. What do you do if you're a foreign government? So our government said, look, we don't want you to sell the treasuries, okay? So we're going to create a facility where a foreign government can do a repo, get the liquidity they need without selling their treasuries. That's why we invent the FIMA. So what we're going to watch is we're going to watch the 30-year, and we're going to watch and see if the governments help us out and use FIMA, or do they just sell? What do you think? Like and follow and tell me in the comments.